Alright guys, welcome back to the channel and welcome back to the Order Blocks trading group. Here we trade the markets using the order blocks, market structure and institutional order flow. We like to keep things simple. The forex market is hard enough. So guys, please don't make it any harder. Keep things simple. Alright, and if you are new here, please consider subscribing. Hit the notification bell icon so that anytime we post a new video like this, you'll be notified about it. And if you like this content, please give us a thumbs up. Comment and share with your friends and families. Alright, that being said, let's jump right in. In today's episode, we want to consider the concept of liquidity purge and break in market structure. Liquidity purge and break in market structure. Now, this is a very important topic, but we try to keep it very short. Now, when we talk about liquidity, we are talking about orders in the market. And orders in the market refer to your pending orders, including your buy stop, sell stop, buy limit, sell limit, market execution, and your stop losses, of course. To be frank with you guys, the algorithm that drives the market seeks out for liquidity. Liquidity is the fuel of the market. What drives the market is liquidity. The smart money will not move price unless they have an objective, and that objective is liquidity, where liquidity is resting in the market. Liquidity, in a simple language, is money, floating money in the market. Now, take a look at these two diagrams. Take a look at them. Take a look at these two diagrams here. Now, this first diagram is what is known as equal highs or triple top. Equal highs or triple top. Now, you must understand that the market makers understand the trading mindset of those who trade the standard retail method. Because traders have been taught to sell at resistance and to buy at support. Sell at resistance and buy at support. That is the normal trading standard method. And the smart money understand that very well. Now, in order for you to understand liquidity, I want to explain it this way in a layman's language. In the market, be it in the forex market or the general market, the open market, there are two participants. You have the buyers and you have the sellers. There can never be buyers if there are no sellers, and there can never be sellers if there are no buyers in the market. Now, the same thing happens in the forex market. When you find price on your chart printing equal highs like this or equal lows, double top, double bottom, triple top, triple bottom, what that tells you is that smart money is accumulating here. Smart money is accumulating. And if the smart money wants to sell, they need a buyer to sell to. They want to find buyers who are willing to buy from them. If they want to buy, They need sellers that they can buy from. Do you understand? Now, if the smart money wants to push price down, if they want to sell the market, they will need buyers to fill in their orders. They need your stop losses here, guys, to fill in their orders in order to be able to move the price down. If they wanted to go up to buy, they will need sellers. And so they need your stop losses below to fill their orders in order to be able to move up. That's how the market runs. I want you to understand that. Well, now, when you find a pattern like this, in the standard retail trading method, they tell you this is a strong resistance. Price cannot break through it. And you know what? They will place their sell orders here because they believe the price cannot break through it. And when they place their sell orders here, what do you think, where do you think their stop losses will be? Above here, of course. 5 pips, 10 pips, I don't know. They place their stop losses above this side. And another set of traders that will be participating in this area here will be breakout traders. They know that this is a resistance. According to them, this is a strong resistance. And that if price breaks out of this resistance, that means that price will rally up. And so they wait. Immediately they find this green candle breaking above this, what they term as resistance here. They will jump in and place their buy orders. And when they place their buy orders, where do you think their stop losses will be? Below, of course, perhaps here, 10 pips, 50, I don't know, but their stop losses will be below. And the market makers, because they want to sell the market in this case, they will push price up. They'll push price up with this candle. And why do they do that? So that they can capture the liquidity that is resting above this equal highs here. They push price up. And immediately after that, you'll find them pushing price down with so much momentum, to the extent that sometimes it closes below the lows here. They have captured all the liquidity resting here. That is what we refer to as liquidity graph. That's what we refer to as liquidity graph. They push this one candle up and capture all the liquidity resting above these equal highs, and then they drop the market. Now, the second scenario is this type of scenario that you are seeing here. This type of scenario, this is the second scenario that you can look at. Take a look at this second scenario. Now, for the traders who trade trend lines, this is for them. They said price will come, hit the trend line the first time, move up, come again to hit the trend line the second time. They say this is a strong support. So what do? They are waiting for price to come back to this trend line, to hit it the third time so that they can take price up. So they place their buy orders here, waiting for price to come and respect this trend line and move up. And the market maker know that. So what they do is that they push price a little bit upward, and the retail traders will think market was going to go up, and all of a sudden they drop price again here. Immediately after dropping the price to capture all the liquidity resting below this trend line, they push price up with so much aggression so that the retail traders will not be able to come out of the market immediately. So they push price up with this one green candle after they have captured all the liquidity resting below this trend line. Now, I want to tell you guys that if you want to trade liquidity, if you want to know what a liquidity is, because a lot of traders have been asking that they are confused about what is liquidity graph. what is liquidity grab or manipulation and break in market structure. Now, let me give you the rules here. The rules here are that, one, take a look. The rules here are that, number one, for liquidity grab, please take note of these two rules, two important rules for you to know the difference between liquidity grab and market structure break. Now, for a liquidity grab, number one rule you must follow is this: whenever price breaks above equal highs like this, or all highs or lows, you want to see it break with only one or two candles max. One or two candles max. In fact, the best type of liquidity grab is a candle wick. That candle wick above this equal highs here. A candle wick, not a body candle close. That's the best form of liquidity grab. Well, sometimes they issue a candle close like this above the equal highs or lows. So the number one rule for you to know that this is a liquidity grab is that it shouldn't break that level, that so-called resistance level, with more than one or two candles max. If it now breaks it with 3, 4, 5 candles, that is no more a liquidity grab. That is a break in market structure. Anything from 3 candles upward is a break in market structure. Please understand that one very well. That's the number one rule. The second rule is that after the grab of liquidity, immediately after the grab of liquidity, you want to see price move down to break structure low. In the case, if they capture liquidity up here, you want to see price move down immediately to break the structure low here. If they grab liquidity down, you want to see price move up to close above the structure high there. These are the only two rules that you need to know that this is a liquidity grab. If it is a break in market structure, it will have to break this level, this resistance level, with 3 or more candles. When it is 3 or more candles, then you know that is a break in market structure. All right, guys, I want to show you some examples because I intend to make this video very short. Let's look at some examples. Okay, guys, look at this now. Look at this example here. This is what you know. This is what is known as double bottom, equal lows. Look at price came here first and went back up. Came again the second time and reacted. Now, when retail traders see this kind of structure, they call it resistance. They said when price returns the third time to this point, they will place their buy orders so that they can take the market up. They expect price to come and respect their trend line or whatever here to take the market up. And look at what smart money has done here. They push price down for retail traders to believe that this structure, which has been printing lower lows, lower high, lower lows, lower high, is going to continue. They push price below this very support level, the retail support level here. They push price. Look at, they push price down for retail traders to believe the downtrend was still going to continue. Immediately after that, they pull price up. Now, sometimes when the smart money now captures liquidity like this here, and they find out that not too many retail traders fell for their trick. What they do is that when they don't have enough orders to push their price up that they intended to do, what they do is that when they move price a bit up like this, they will come down again. Look at this long wick. It was a bearish candle. They came down again because they didn't have enough traders who fell for their trick here. So they came down again with full force with this candle. There was a time this week was a full body candle coming down to convince the retail traders that price was actually moving down to continue with this existing downtrend. And all of a sudden, many traders would have jumped in and they pulled price back up to continue with the uptrend. Look at how they continued with the uptrend. Can you see that? That is what we call manipulation in price or liquidity purge. Liquidity purge. Let's check for one more example. One more example. Let's go for one more example. One more example, guys, and we call it a day. One more example. Let's see if I can find one. See if we can find one more example so that we call it. Okay, right. Take a look at this now, guys. Take a look at this. Take a look at this. I told you price, the manipulation point. In the last video, I told you manipulation points of the market makers are in 6 zones. 6 zones. Check out our last video. You'll find it there. 6 zones. I told you one is equal highs and equal lows. Number 2 is all highs, all lows. Number 3, previous day's high, previous day's low. Number 4, previous week's high, previous week's low. Number 5, previous month's high, previous month's low. Number 6, previous year's high and previous year's low. Take a look at this. This is an old low. Now, those who trade the retail method will see what is happening here and say, okay, this is a support. And so market makers push price up from there. What is the retail mindset? The retail mindset is that when price comes back down to that same spot, is going to place a buy order to buy. And truly the market wanted to go up. But the market makers will have to bring price down, push price down below this old low here. This old low here. They push price down with this one candle. Take note of it. I told you, liquidity graph must not be more than 1 or 2 candles. They push price down with this one candle. Immediately after that, they push price up aggressively with this one blue candle. Look at this one blue candle. This is not the handwork of retailers. This is the handwork of the market makers. They push price up aggressively to close above this high. And they grabbed all the liquidity resting below this place. Think about it. How many retail traders would have thought that this downtrend was going to continue? This is a downtrend. How many traders would have thought that this downtrend was going to continue, and they jump into the market to sell, and all of a sudden the market makers push price up to close above this very, very high. This very high here. Now guys, how do you trade this liquidity graph? Well, the way to trade it, I want to use this one as just one example. Now, the way to trade it is to wait. When price has purged liquidity here, as in this case, price purged the liquidity, wait and see what price action will do. Now, immediately you see this engulfing candle. In our last video, we talked about imbalance. This is an imbalance here, and it is also known as engulfing candle. Once you find this, then the last bearish candle before this break of structure here, structure was broken here, before this break of structure here, the last opposite candle before that break of structure is this red candle here. So you mark it out and wait for price to return to it so that you can take price upward. At some point in time, if you mark this red candle out, price will return to it, and certainly it will react when it gets to that point because of this imbalance that is accompanying that other block. All right, guys, I hope you now understand the difference between liquidity purge and break in market structure. Just a recap: liquidity purge or liquidity capture or manipulation is when you have one or two candle marks closing above or below equal highs or equal lows, or all highs or all lows, one or two candles marks. But when you have a structural break with more than 3 candles, that is no more a liquidity graph. It is a break in market structure. All right, guys, I hope you got value from this video. Well, if you want to know how we trade, if you want to know more on how we trade, please click the subscribe button and the notification bell icon so that you don't miss any of our trades. We still have lots of valuable materials to share with you. And if you have not joined our Telegram group, please do so immediately. I will leave the link in the description below. A lot is happening on our Telegram group page. Please visit that group and you will learn a lot. All right, guys, thanks for listening.